With the markets closed for the weekend, Fubo TV Inc., trading under the ticker symbol FUBO, ended its last session on Friday, September 12, 2025, at a price of $4.27 per share. This represented a modest gain of 2.64% for the day, a flicker of green in what has been a notoriously volatile and often brutal trading history for the company. But to fixate on a single day's closing price is to miss the forest for the trees entirely. The expectation many investors hold is that Fubo TV is a simple, high-growth play on the undeniable trend of cord-cutting and the burgeoning U.S. sports betting market. They see a sleek, sports-focused alternative to traditional cable, a David challenging the Goliaths of media. The reality, however, is a far more complex and perilous narrative. A high-stakes balancing act between colossal content costs, fierce competition, and a relentless burn of cash that threatens its very survival. The real story isn't about whether people are cutting the cord. It's about whether Fubo TV can possibly afford the price of admission to the top tier of streaming, a club where giants with seemingly bottomless pockets roam. The subtle optimism from Friday's session belies a deeper undercurrent of strategic desperation. Just this month, Fubo TV launched its Fubo Sports Skinny Bundle, a lower-priced, sports-focused package designed to staunch the bleeding of subscribers and attract a more budget-conscious consumer. This is the company's latest gambit, an attempt to carve out a defensible niche against behemoths like YouTube TV, Hulu Plus Live TV, and the looming direct-to-consumer ambitions of ESPN itself. The market narrative suggests this is an innovative move to expand their addressable market. The harsh reality is that this is a defensive reaction to significant subscriber churn and the dawning realization that the all-in-one, high-priced streaming bundle is a tough sell in an economy where consumers are scrutinizing every subscription. It's a pivot born from necessity, not necessarily strength. This move subtly acknowledges that their primary product is too expensive for a large segment of the market they need to capture to achieve the scale necessary for profitability. Many retail traders, perhaps using platforms like Robinhood for its user-friendly interface or SoFi Invest for its integrated financial services, see this as a positive development, more choice for consumers. But sophisticated investors, perhaps utilizing the advanced tools on an interactive broker's trading platform or analyzing market data through Fidelity's wealth management services, are asking a tougher question. Does this further complicate the path to profitability by lowering the average revenue per user, ARPU, without a guarantee of massive volume adoption? Looking at the stock's recent movement, the last 2 weeks have shown a surge of nearly 23%, a rally that has undoubtedly excited the bulls. This move was initiated from a pivot bottom in late August and has been supported by positive signals from both short and long-term moving averages. However, a concerning divergence has appeared. On several of the recent green days, including Friday's session, volume has been noticeably lower than on previous upswings. This can be a leading indicator that conviction behind the rally is waning, a potential warning sign that the upward momentum might not be sustainable. This is the kind of nuance lost on those simply chasing headlines, but is critical for anyone engaging in serious online investing. The expectation is that a rising stock price indicates a healthy company. The reality is that a price rise on weakening volume can suggest a move driven by short-term speculation rather than long-term institutional accumulation. Speaking of institutions, firms like Vanguard and BlackRock remain the largest holders, which provides a baseline of stability. However, the constant churn among hedge funds and other institutional players quarter to quarter highlights the ongoing debate about Fubo's long-term viability. This isn't a set-it-and-forget-it stock like Apple stock or even a high-conviction growth story like Nvidia stock. It's a battleground stock reflected in its high short interest and daily volatility. An individual brokerage account holder must be prepared for this stomach-churning ride. The second quarter earnings report from August was a masterclass in this expectation versus reality dynamic. The headline was a significant milestone. Fubo TV achieved its first ever quarter of positive adjusted EBITDA. The market initially cheered this as a sign that the company was finally turning the corner on profitability. But digging into the numbers reveals a more sobering truth. The positive EBITDA was achieved alongside a year-over-year decrease in total revenue, and more critically, a 6.5% decline in paid subscribers in its core North American market. The company beat its own guidance, a common practice in financial reporting, but couldn't mask the fact that its user base was shrinking. The profit improvement came largely from operational efficiencies and cost-cutting, not from top-line growth. This is the critical disconnect. The expectation is that a tech company on a path to profitability should be growing its user base. The reality for Fubo is that it's currently achieving better bottom-line metrics by managing its decline, not by expanding its reach. This raises a fundamental question about its business model. Can Fubo TV ever become truly profitable without the massive scale of its competitors? The content costs, particularly for live sports rights, are astronomical and non-negotiable. Every subscriber is a loss leader until ARPU, driven by both subscription fees and advertising, can substantially outpace the per-subscriber cost. This is the central challenge, the puzzle that Fubo has yet to solve. Fubo TV's business is a three-pronged spear, with each prong having its own set of challenges. The primary revenue stream is subscriptions to its virtual multi-channel video programming distributor, vMVPD. Here, it competes not only with the aforementioned streaming giants, but also with traditional cable and satellite providers who are desperately trying to retain customers. The second prong is advertising revenue. Fubo has made progress here, growing its ad ARPU, but it's still a small fish in a vast ocean dominated by Google, Meta, and the ad tiers of major streaming services like Netflix and Disney+. The third and most speculative prong is sports wagering. The grand vision, the ultimate bull case, was to seamlessly integrate its Fubo Sportsbook with the live viewing experience, creating a flywheel of engagement and revenue. The expectation was a game-changer that would revolutionize sports entertainment. The reality has been a costly, complex, and ultimately failed experiment. Fubo shut down its own sportsbook operations after concluding the capital required to compete against entrenched players like DraftKings and FanDuel was simply too immense. It now seeks partnerships, a significant downshift in ambition from its original goal of owning the entire ecosystem. This strategic retreat was a necessary, pragmatic decision, but it also removed one of the most significant pillars of the long-term bull thesis. Comment below what you think Fubo TV's biggest hurdle is to achieving profitability: content costs, competition, or marketing scale. Your perspective helps us all understand the sentiment around this name. Looking to the future, the path forward is fraught with both potential catalysts and existential risks. On the bull side, a potential catalyst could be a strategic partnership or even an acquisition. As the media landscape consolidates, a company with a dedicated, high ARP, sports-focused subscriber base could be an attractive target for a larger player looking to bolster its position in live sports. Furthermore, the launch of the Skinny Bundle, if successful, could re-accelerate subscriber growth and create a new funnel for upselling customers to higher price tiers. Continued growth in advertising revenue is also crucial. On the bear side, the risks are stark and numerous. The biggest remains the ever-escalating cost of sports media rights. Fubo is a price taker, not a price maker in these negotiations. As leagues command higher and higher fees, those costs must be passed on to consumers, which could lead to further churn. Competition is another massive headwind. The joint venture between Disney, Fox, and Warner Bros. Discovery to create a combined sports streaming app presents a direct and formidable threat. Why subscribe to Fubo when you can get a comprehensive sports package directly from the content owners themselves? Finally, there's the ever-present risk of dilution. Fubo is not a cash-generating machine, it consumes cash. This means it will likely need to raise more capital in the future, which could come in the form of issuing more stock, diluting the value for existing shareholders. This is a critical consideration for anyone managing their own investment portfolio, whether through a platform like Fidelity, which offers extensive research and a wide array of Fidelity ETFs and Fidelity mutual funds, or a more streamlined app like Robinhood, known for its Robinhood fractional shares and Robinhood stock trading features. An investor needs to ask if they are comfortable with this level of financial risk, a risk far greater than that associated with blue-chip names like Tesla stock or Apple stock. In summary, the story of Fubo TV is a captivating drama of ambition versus economic reality. The expectation, fueled by the compelling narrative of sports, streaming, and betting, is that of a disruptive innovator poised for explosive growth. It's a vision that has captured the imagination of many retail investors looking for the next big thing in the world of online investment. However, the reality, found in the fine print of its financial statements and the brutal competitive landscape, is that of a company fighting for its life. It is a company that has shown operational discipline in managing its